Gotcha.
Hi all, welcome to Free Float. I'm Sham and I have Kishan with me.
Hey, Sham.
Today,
Sham.
hey, today we are going to be discussing what I feel is one of the most crowded trades amongst retail investors. Yes, it is momentum investing. I have Kishan with me to sort of walk us through what it is and what he thinks is coming down the pike for momentum investors in India. Kishan, do you want to start us off?
Yeah. So Sham, I think like almost everyone today, knows momentum. Like even if they don't know, don't know about factors. If you ask someone, why the stock has gone up, they will say momentum. Like especially someone on CNBC.
Yeah.
And I think that like almost anyone who has any kind of a momentum strategy has done well in the last 1 year. But my thing is that as someone told me sometime back, don't confuse brains with the bull market, right? So like anyone almost with a with a moment strategy has done well, and they think that they're the smartest people in the room, because that they found something that is great and unique. And like you might think, okay, maybe I'll forget about everything else and just focus on like momentum strategies, which I think is not a bad idea. Like just by going by what like momentum is, it is one of the most strategy. Like it's performed better than all other most other factors, and it's persistent across markets. It does shown for over a time, but there are downsides to momentum, and so that's what I'm interested in, because uh, even for a fundamental analyst, right? He might have a universe of like 100 stocks, and if he picks the like 20 stocks based on momentum, there are chances that his performance will improve. But but even for that guy, there are some disadvantages using momentum, and so I try to talk about that, mainly that one, you could spend years in a drawdown. Like momentum strategies have probably 2 or 3 years of drawdowns. Like you can see just in India in the last 3 years, 2017 to 2020, or sorry, 2018 to 2020, which is 2 years. They had extremely painful drawdown. Like Nifty had relatively positive years, not maybe big positive, but maybe in like single digits, while moment strategies were were like underwater for 2 years. And it just like market, things change, that that moment strategies had a big upswing. But it is possible for a moment strategy to have like longer drawdowns, or longer duration drawdowns, and you have to ask yourself, are you okay with having multi years of
So I'll tell you this: most investors will exit at the first 20% down. Okay, that's been my experience. 20% is somehow like the psychological limit, and at that point, they extrapolate it as to how many years do I now have to wait in order to make this back, and they'll pull the plug at that point. And that's like the worst way to go about momentum investing, and I feel that is partly the reason that explains its success, because most people cannot withstand the drawdown. And when you try to do any sort of risk mitigation on top of that, you pay for it, right? You pay for it through transaction costs, even in normal markets. So like we have all these momos going on, right? And one thing that is guaranteed is that you will be transacting pretty much almost every day. either one or two stocks. And when you do that in India, you pay your STT and all the other transaction costs and SEBI fees and whatnot. And when you add up the costs, you still come out ahead. But the problem is that what most investors forget is that these costs you incur whether the market is up or down. So even when you're 20% down, you're still transacting and you're still incurring those costs. And that, most investors can't take that. They'll be like, I am down. Why am I paying all these fees? So it's a very difficult thing to wrap your head around, that costs are something that will be with you no matter what.
Yeah, and I think that's also about how people see it, right? So people see that so momentum is not well understood by most investors, or what factors are, and so they don't see a strategy. Especially if they had somebody like analyzing a company, and told them that this company has prospects, and has that they're putting up a new plant, and the new plant will have will increase the production, and
the plant will go into a big oak tree, and all that.
In 3 years the sales will triple, so the company's stock price will double. At least it will double, if not triple. So you just wait for 3 years and hold on, which is what most PMS managers do, because PMS managers, in 2018 to 2020, most of them had a tough time, and especially because they were all invested in mid caps and stuff like that. And they also paid fees. Like, it's not like PMS managers are, almost no one is just performance only fees, but they're still stuck around.
Right.
They're still stuck around. It's more likely because people like to hear stories that I understand. And if you just say this moment of factor, I backtested it, and there are periods of drawdown and stuff, you just have to hold on to it. People are more disinclined to not believe some model or some strategy that you backtested over some story about some plant coming up, the stock that I found, and they're more willing to, especially if they found it themselves. Like if some investors found some stock, and that, like ITC, you might hold it for 5-6 years without it going up, and you'll make up all kinds of stories about why you're still holding it. It's just a matter of time. It'll go up. But you won't have the same patience if it's a model that someone else has back tested, and it might have very good scientific foundation to it, but you're not likely to believe it. So I think that's one of the reasons why people jump onto the bandwagon. It's good, but when it goes wrong, I think people jump out very quick. And also it's highly correlated to Nifty. Like it will do well in a bull market, it won't do well in sort of a bear market, and
So my take on this is slightly different. I think momentum in India is not correlated to anything. So it's a beast of its own. So you may be looking at the Nifty 200 or Alpha Index or whatever they call it. So over there they pick only large cap stocks. So you're right in saying that it may be correlated to the Nifty. But if you are running a more sort of go anywhere strategy that does not have, I have to pick only the top 100 stocks or whatever, then you'll notice that, it switches its allegiance. So, in years where Nifty is going strong, it'll tilt towards large caps. In years where mid caps have gone strong, it'll tilt towards mid caps. So it has the ability to adapt. But that is not the worry for momentum investors. The worry for momentum investors is when there is a large scale bear market where like Nifty is flat and mid caps have tanked say 30%. Your momentum strategy is likely to draw down maybe about 40% after cost, and you're supposed to hold on to it. But the problem is it is really not like that 40% drawdown is going to happen in one stretch, right? It's not like, oh, it is January or maybe it's March 1st to March 10th, the market tanks and you have your drawdown, then you wait, right? That's not how it happens. What happens is market goes down 5%, and then it bounces up, then it goes down another 5% and bounces up a little bit. So like this, like a tennis ball falling down a flight of stairs, right? So what happens is your momentum strategy is trying to keep up with that. It buys everything when the index, when stocks are going up, thinking, oh yeah, this is the turning point, only to get disappointed and then exit all those stocks when the market dives again. So at every point you're incurring costs. So your 40% drawdown is like how I think in the Thinking Fast and Slow, they describe it. How do you want your bandage to be pulled, right? Do you want somebody to just rip it off, or you want it to go slowly? So this is like the slow ripping off of a bandage. There's no zip and you're done. It's like that slow ripping off, and it's very, very, very painful. And you need to go through at least 1 or 2 cycles of momentum drawdowns to truly understand the kind of mental torture that watching a portfolio like this is.
Right. And yeah, I think Jero told me that if you want to invest in momentum, you should be mentally prepared to lose 50% of your portfolio.
Yeah.
Because at some point that will happen.
Yeah, it's inevitable. And you can do all sorts of jazz, man. You can do risk management, you can do stop loss, you can do some trend overlay, but it is just not possible to avoid those. But here's the thing, even if you do value investing, that is going to happen to you. Yeah. Okay. Yeah. So it is not like, oh, it's only momentum's fault. It's just, I would say it is the factor's fault. So when you do factor investing, you are tied down to some 25, 30 stocks max, right? You cannot diversify beyond that. But if you look at, if you're running just a index fund portfolio, right? So you have your Nifty 500 index fund, you have your US S&P 500 index fund, and a bunch of bonds. That is likely to be way more stable. Mostly thanks to S&P 500, but still, it is not going to draw down 30% in your face. But the problem is, if if the only thing you invested in is in momentum, then you are going to see that your portfolio statement, and you're going to lose your mind, because it is not something that it's not everybody's cup of tea. And the worst thing is, it becomes real when you think of it in in rupee terms rather than percentage terms. So say you put 50 lakhs in momentum strategy, hypothetically thinking, oh yeah, 20% drawdown is not, I can take it. But you translate that 20% on a 50 lakh portfolio, right? That is most people's annual salary. That's what you're talking about. That's how much you lost in your portfolio, right? So, yeah. So it's very painful.
And it is painful. So how do you mitigate it? So you mitigate it through 3 ways, right? Diversification really doesn't work in India because you have only other equity strategies, right? So you can't diversify into other equities because they're all highly correlated. They all fall. Some will fall less than others, but they will all fall. So so that doesn't mitigate. Second is through diversification through asset allocation. That would prevent some amount of the extent of the drawdown. That will at least cushion some of your drawdown. So that works to an extent. Third is some kind of like like what you do for all stars, where you have a stop loss, and the stop loss moves into cash as the market falls, because your stop loss get triggered, and as most of stop loss triggered, you move into cash. But all of those things are not perfect, like you said. They all have a draw. All have a downside. You could have some kind of especially at the peak, when the market falls, it falls it falls like a cliff. It falls like off a cliff. So those corrections are extremely sharp, and if you are in the beginning of a month and you rebalance at the end of the next month, you are exposed significantly to those risks, because you don't and you will fall as much as the market falls. And we have seen in a recent past, those drawdowns happen in a month or two. They will happen very swiftly, because everyone's doing what you're doing, in some ways, and so somebody's being smarter than you, and has a strategy that does this at a much quicker pace. So how do you really mitigate? You just have to go with the flow.
No, initially when I started this so-called factor investing, right, I was on a monthly clock. Okay, so I was like, I don't want to pay all these brokerage fee, so I'm going to just rebalance once a month and forget about it. Then I realized that all this, doesn't work from a risk management point of view. So I had to embrace, dynamic rebalancing. So every day I check my portfolio, and I trigger stop losses. And I've sort of grudgingly come to accept that this is my fate. So some of the gross returns goes to the evil government, so to speak. So through so I come to embrace it, because in my mind I feel if you stick long enough to it. So recently, one of these Momo strategies hit two sharps. Okay, so there is a Momo strategy running right now. That is a two sharp strategy, which most quants will give the left nut to sort of to achieve in the real world, right?
Yeah, Shyam.
Yeah. So the thing is, if you stick through it long enough, and this was all started mid 2016, right? So if you stick with it long enough, you will get there. Okay. There is a there, by the way. So you will get there. And the only question is your behavior during these market turns and what you do, right? So in my case, what happens is every time there's a rebalance, there's leakage. So so if you start with say 10 lakhs and you rebalance, you can't allocate all of the 10 lakhs, right? So you're going to allocate 9.9. So tomorrow there is another rebalance. So 9.9 becomes 9.8. So there is no perfect rebalancing. And this leakage accumulates over a period of time. And it's up to you to decide, when you're going to take that cash out of your brokerage account versus, put it back in the portfolio. Now, whenever, I feel the market is sort of, over its skis and there is a trigger point coming, like either it's a budget or US Fed doing something, there's some announcement coming. So I just don't put it back in the account. So I just let it accumulate. So that 10 grand every day becomes 1 lakh, 2 lakhs. It becomes like say 20% of my overall stuff. I mean my portfolio in that particular brokerage account. I just let it accumulate, and when the the thing passes, or when there is a drawdown of more than 5% or 10%, in the market, I put a little bit of it back. So like this, I'm, sort of saying that, look, even with the fixed amount, right, you don't have to allocate all of it to your strategy. You can sort of use the strategies trading activity to gauge whether you want to re-up or just wait, pick your moments. But this is dangerously close to being like a market timing sort of thing, which is not going to work all the time. But in my experience, what has happened is, by knowing that there are trigger points coming up, right? So you can choose not to keep re-upping, but your portfolio is still chugging along, right? So it is,
right.
It's just not at the full 100% capacity. Just like you're shaving
And you're
off
avoiding,
few things.
yeah, but it's also like discretion. I would say, it is, you're using some amount of discretion for that.
Absolutely. There is no. So this goes back to rebalancing frequency, right? So everybody is on a time clock, but the market doesn't care about whether it is open close or on 9 a.m. or 10 p.m. right? So what people should really focus on is a volume clock. So so look at because volume is information, right? So Nifty, if Nifty trades, say, I'm just giving out some hypothetical, right? Say 1 crore volume in 5 minutes on average. So there'll be instances when it trades 1 crore in 1 minute. So that 1 crore in 1 minute has a lot more information content than the 1 crore trading in 5 minutes. So you can basically crunch your time series or expanded, like an accordion, based on a volume clock rather than a time clock. And that will give you a better illustration of when to rebalance. So you're better off rebalancing after a huge volume spike in the market.
Okay.
So when there's a lot of trading activity, so it means a lot of information got reflected in the price, right? So you go and rebalance at that point.
Okay, understood.
Rebalance in the sense you add more funds at that.
But that's okay for me and you. How does a retail investor do that? Because a retail investor would not be able to do that.
Yeah, I don't know. See, there are different shades of retail investors in India, right? So there are people who pay close attention and they really like this game. So they may be able to look at it from a volume point of view and actually do this. But the rest of them, they can sign up with us.
And but it's perhaps it's I think one of the reasons why momentum, as picked up, is it is also like easy to do. Like I think like almost anyone with an Excel sheet can do momentum.
See, I disagree with that. Okay, so
really?
You're talking about a very naive implementation of momentum, and while it's like saying the Romans built bridges and aqueducts without knowing the science behind it.
Understanding engine.
Yeah. So sure, they actually invented concrete, by the way, and the science was forgotten through the dark ages and it was rediscovered. So my point is that you don't have to be a scientist to build bridges and all that. And modern day engineers can't even get out of bed without AutoCAD. But the thing is, the sophistication involved in running risk cannot be adequately reflected in simple Excel models. It is not something you do with downloading your daily closes and and putting it in Excel. There are a lot of things that you need to be aware of when you run risk at a larger scale, and I don't think it is advisable to do that with it might sound simple, and I agree that almost all models start off being simple, and it is not to say that it can't be done. It's just that I wouldn't trivialize it.
All right, that's interesting. I mean, that's an interesting perspective, because I'm always taught that the reason why momentum is so popular is because it's also the easiest to do compared to value or
Sure.
quality, or
look, it is easiest to do if you are a simpleton in a bull market, right? Sure, it's easy to do.
Right.
But the thing is, you have to look at it from a 10-year perspective, right? And the other thing is, I disagree that momentum is simpler than value. It is not. In fact, value is simpler if you do it right. Right? Even the market kind of throws you a sort of fat pitch every 3 years in India. Okay, it's something or the other, some nonsense or the other. It's never the same reason, but every 3 years I've seen the market go down 20 to 30%. So when that happens, you just go and buy all your quality stocks, and you sit down. That is value investing in India. There are like some 30 stocks, that are high quality, and they all tank with the rest of the market when things are bad, because FIIs run away from India in Flash Gordon, right? They're gone. So when they do a fire sale and get out, that's when you load up on all these 30 quality names and you sit. So that is value investing in India, and it is way simpler to do than all this momentum shit, because there's no stop loss, there is no daily checking, there is no downloading prices, nothing. It's the same stock. But then 30 stocks have not changed in the last 10-15 years. It's the same thing.
But then if you go through the formula of with the value factor, which is price to book, and you can do it many ways. These stocks and price to book, even after 20-30% drawdown, they're still expensive, and they still would not fit your lowest stocks.
Yeah, so everything is relative, right? I think we broached the subject, when we discussed magic formula. So what happens, is that at the peak of the bull market, if you're rebalancing, then all your portfolio will be filled with junk that nobody likes it, even in a peak of the bull market. So when the correction happens, these stocks tank the worst. If your regular stuff is tanking 30%, this will tank 60%. So it is so blindly doing this value factor in India. I wouldn't say just in India, it does happen even in the US. So value factor, the actual factor, outperforms only when the market is bouncing up from the lows. So that's when most of it happens. So it also goes through a drawdown, comparable to the rest. The only thing that doesn't have the same sort of drawdown is the quality factor. And in India, those quality stocks are very well known, and everybody has it in their watch list and whatnot. So so you'd rather do this buy the dip with those quality stocks than with anything else. And it's actually way more simpler than momentum. But that doesn't give you returns, by the way, because everybody knows that these are quality stocks, and there's a limit to how much you can squeeze out of them. So in terms of work, it is a lot lesser, but you'll still beat 80% of all these active managers, from mutual funds to PMS guys. You'll beat them by doing this, but you'll still not be able to beat momentum.
Funny.
Yeah.
Yeah.
And the other thing is,
so I think,
This I feel the last the last reason why momentum works in India is and I feel it will continue to work is because we have a very immature investor class, from asset managers down to retail investors. We still haven't sort of internalized the cult of equity. Okay,
Yes.
so we are still a very young investor class, overall, and I feel we are still prone to those excessive fear and greed cycle. So as long as that persists, this is these factors will continue to work. Unlike, say, in the US, where pretty much every household with savings has invested in some fund. Yeah. I would say that's a very mature thing. So even though they act immaturely, and you get to hear all these meme stocks and all this stuff,
Right. But far greater, I mean, the far greater of the population is invested in, I mean, to the 401ks and to,
So the all this memes stuff that you're hearing is from a very small vocal minority. They've had their fun. It's a few $1 billion, but there are trillions of dollars of wealth that is invested in just like stable money. It is not going away anywhere. So it's a different ball game there compared to compared to the Indian markets. All right. So with that, I think we'll wrap up this week's discussion. So we will come together again next weekend